Please.
$27.2 trillion. That's like 1.6 times average GDP over this period, okay? In combined deficit spending and money printing. The money printing was 8 point something trillion dollars alone. This has never been done. This is saying that economists and the Federal Reserve know better what's good for the economy than the economy itself. The economy has no problem booming and then slowing down and restructuring debts and knocking out zombie and failed companies. That what people don't understand is free market capitalism goes both ways. You not only have to encourage and allow innovation, you have to allow companies to fail.
Last week, the US Treasury Department reported that the US government ran up another $500 billion in budget deficit in the first quarter of the fiscal year. Between October and December 2023, the budget deficit totaled around $510 billion, with a $129 billion shortfall recorded in December alone, more than 52% higher than the deficit for December 2022. The obvious increase in the deficit pushed the US national debt past $34 trillion for the first time in history, less than 4 months after it first hit $33 trillion in September. The budget deficit report is one of the 2 alarming economic reports that were released last week. The Bureau of Labor Statistics also released its December 2023 Consumer Price Index report, marking a 0.3% increase in December, following a 0.1% rise in November. Core inflation, excluding food and energy items, was expected to rise 3.8% year-over-year in December, following a 4% increase in November. However, core prices rose 0.3% month-over-month in December at the same rate as November's increase, making the year-over-year increase total 3.9%. The latest CPI data raises the question of how the Federal Reserve will redirect its policies moving forward. During its last meeting, the FOMC indicated that it is considering 3/4 percentage point rate cuts by the end of 2024. However, traders in the Fed Fund futures market are pointing to a strong chance of an initial rate cut in March, to be followed by 5 more reductions through the year, taking the Fed's fund rate down to a range of 3.75% to 4%. If inflation remains sticky or continues to climb rapidly in 2024, then the market's expectations will be woefully dashed, with a strong price reaction across the board. This is why Harry Dent, a popular financial advisor and economist, predicts a severe crash in 2024. Harry believes we are quite close to what could be the biggest crash in our lifetime. Not of the US economy, but of asset prices in equities, commodities and cryptocurrencies. We will now bring you clips from Harry's recent interview with ITM Trading. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
And I think they put this off, I think, as long as they can. And what they finally happened here, Daniela, is they stimulated so hard the one final time. Now, this is from 2009, 14 years straight stimulus, first time in history. But they went off the charts in the 2 years following COVID. And by doing that, they created this sudden 9.1% inflation when we were going down, as my numbers said they should, towards 1%. And that caused them to say, oh my gosh, then they had to turn around with that inflation and tighten, and they tightened 525 basis points. That's the most since 1980-81, which caused the deepest recession since the Great Depression back then. So everybody's thinking, oh, well, the economy can handle this tightening. No, this economy's been stretched now many, many years past the demographic peak, which did occur in late 2007. That's why we had that strong downturn 2008-9. That downturn would have gone another year and a half longer if they hadn't stimulated out. And then a technology cycle came in very positive into 2020, and that's been down since. So the fundamentals are down here. The economy, I'm just telling you, I've studied this economy for 40 years now. The economy wants to take a rest. The economy wants to get rid of bad debts and zombie companies, and the government and politicians won't let them. So I say what happened here, because they overstimulated, that was the mistake, and now they over-tightened. This tightening, and this is another clear fact that people don't talk about, it takes basically a year, more like a year and a half, to fully hit. So the tightening that peaked in March of 2023 will not fully hit until late 2024. And I think this year we are going to see the economy
Yeah.
down because they've already put this in motion, and it'll be many months before they turn around and loosen, and it'll be too late.
What is that?
Ask yourself, have these people, either of them, you just mentioned the two big names on the Fed, it doesn't matter how far you go back, any one of them ever ran a business? You know? No, not a single Fed chairman has run a business. Businesses know that you have to grow and then you have to cut back. I mean, my first stint after Harvard Business School was consulting to Fortune 100 companies were getting eaten by lunch by the Japanese, and the second stint was small businesses in California, and all they do is go under and then restructure and cut costs and get meaner and leaner. That's how the economy actually works.
Okay.
You're not supposed to boom forever. You're supposed to grow and then restructure and set back and reevaluate and go again. If I was just looking at charts and didn't know what I was looking at, this would be a slam dunk. All we're doing, we had a big bubble, both in real estate and stocks at the same time. You got to remember, the first time stocks bubbled first into 2000, when that bubble wore out and crashed, people went right into real estate and bubbled that up into 2006, and then that crashed, and then everything came down into 2007, 8, and then we would have had a deeper recession without that, or depression, okay? So now we've had both bubbles, stocks and real estate, artificially boosted this time by massive money. When money gets thrown in the economy, they didn't send checks in the mail to Homer Simpson. This money bought financial assets directly into the financial markets, and then it ends up boosting everything, bonds, stocks, real estate, everything, and then you get a giant bubble. Well, bubbles only do one thing. The first bubble in stocks was 2000. It crashed 78% in the NASDAQ, the bubblier stocks, in a boom, which was going to continue, as my indicator said. This time, it's got to crash 86%, the S&P 500, just to get back to the last low in early 2009. This isn't erasing the entire boom since the early 80s. It's just erasing the artificial bubble since 2009, which was not even a natural growth period. It was artificially created.
An 86% crash in the S&P 500 will take the stock index's prices below 1,000, which will be its lowest price since February 2009. That would be the mother of all crashes. And it won't just plunge the markets and the US economy into dangerous territories. It may very well take down the entire global economy. Harry explains that as disastrous as that sounds, it is normal for every healthy economy. He believes the market should be allowed to naturally rise and crash to wean out weak businesses and unmotivated executives and give room for true and healthy competition. But the question is, will the Federal Reserve and other central banks allow such natural growth without manipulating the markets by printing recklessly? Past precedents show they wouldn't. Let's get back to the video.
2012. Now here's the shocker. That's 50%. Hey, I don't care about 86% decline in stocks. Most people, everyday people, don't own that much stocks. What's going to kill everyday people is their home going down 50 to 60% just to get back down to recent 2012 prices. What that tells you, Daniela, how big a bubble we just had. And there's never been one bubble, and I've studied every one in history in the last 20 years since these bubbles started to become a major feature of our economy. Every bubble has burst, and they burst drastically. Stock bubbles tend to go down. Again, like 29 to 32, 89%. That's a bubble burst.
How long would we have to wait for it to become a buyer's market in housing?
Okay. Housing, a longer period. Last time, housing peaked ahead of stocks in early February 2006 and bottomed in mid-2012. It took 6 years to reach a bottom. On the other hand, in early 2009, when stocks bottomed, most of that damage was done and you could have already gotten really good bargains in houses, okay? So it's going to take longer for real estate to bottom. There's going to be a long period when people can buy houses at bargain prices, but stocks already had the first crash in 2022. Only the largest leading indexes had barely eked out a new high. That's creating divergences now. The small caps will never go up another 20% and to make new highs, and that will create a huge divergence that says we ought to be expecting a major long-term top alone. Stocks ought to be over this somewhere between late 2024 and mid-2025 because we've already done some shakedown in stocks. Let me tell you what I really want to hold. I want to hold the longest term US Treasury bonds. I know we got too much debt, but so does everybody else in the world, and we have less debt to GDP, the US, than Japan and Europe and all of our developed country rivals, okay? We're the best house in a bad neighborhood. The 2008 crash, when it got to its worst, even gold fell 45%. And stocks bottomed there in early 2009. Real estate, everything went down. Only the U.S. long-term Treasury bonds went up. So T-bills will preserve your crash when everything else falls. That's great because you're avoiding the losses and then buying at the sale of a lifetime. And here's what you got to not miss here. This will be in our lifetimes, and similar to 82 if you go way back, okay? A rare time where you can buy stocks at prices you will never, ever see again. And not just here, but the up and coming country in the world. China's done. China's overbuilt. They've got enough empty houses to last them for everybody else that's ever going to move to a city because they overbuilt. India is the next China that in the next 4 decades is going to expand.
Are you bullish gold?
I am not bullish gold. I'd say gold's going to go a little higher. In the last downturn, gold went up in the early stages, first half of 2008, and then it went down 45%. Now that was a short-term downturn, and it came back slowly. So gold's not the worst place to be, and if somebody wants to have some, fine, in case Peter Schiff's right and we have an inflationary blowout. What I see is in every single financial asset bubble in history, no exceptions, is the financial assets deleveraging and going down that causes a deflationary downturn. Most recessions are not that deflationary, okay? It's only in the 30s that we saw major deflation, and that's what we should see coming out of this because financial assets come down substantially. We've had a bubble in everything.
The likelihood of further decline in gold and silver prices, especially in the short term, is high. However, even if they come, they will be short-lived because there are many more reasons for increasing gold and silver prices. Factors like quantitative easing, a weaker dollar, global monetary system collapse, and others do not just support increasing gold and silver prices, they do so over the very long term. Please share your thoughts on Harry's predictions for gold and silver prices in the comments section below. Subscribe to the channel and turn on post notifications for more videos like this. You can also check out our other videos on gold, silver, and other metals and commodities. Thanks for watching.